Awesome. So it's my pleasure to welcome everyone again to another SUP46 session, where we invite experts to share their learnings with our founders and entrepreneurs in a tangible and actionable way. This is supposed to be theory applied in reality for startups and entrepreneurs. It's going to be a 45-minute session with a 15-minute Q&A. And as always, for best experience for everyone, keep your mics on mute, and also please turn on your webcams. It's going to be way more interesting and interactive for us, for me and Andrew. So please go ahead and do that, so we can see your faces, and you can raise your hands and stuff. Recordings will be added to our library. Presentation deck will be shared afterwards. Thanks, Kat, for coordinating, and she'll also keep track on the lobby. Don't forget to respond to the survey afterwards, and it will help us improve and keep this content relevant and good. Now, it's my pleasure to welcome today's expert, Andrew, a friend of mine and former colleague, and he will talk to you about finance for startups. Andrew has been in several different roles, from strategy, operations, finance, at several venture-backed companies, from everything from early stage to hypergrowth. Certified public accountant from PwC, done a lot of auditing, VC auditing, joined Stripe back in Series C time, 2014. Was that 2014?
That's right, yeah.
And yeah, as the first finance hire, and helped scale the company, and went for the first hypergrowth period, which is super exciting and very relevant and interesting. Also, former chief of operations at Feather subscription company that went from 6 to 100 people and raised over $75 million. And now consultant and advisor, go-to-market strategy, operations, and finance. And short, operator turned investor. So I think it's a perfect match to share your experience with you guys. So, and again, for those attending, thanks for jumping in. And if you have any questions, just raise your hand or put the hand up, the hand icon in the chat, and Kat will let us know that you have a question or thought. All right, thanks everyone for joining. I'm going to leave the floor now to Andrew. Welcome.
Thank you so much, Seb. Really appreciate it. I'm excited to talk to you today about some startup finance, and I can tell by the expression on your faces that you're excited too. Seb mentioned I've had a bunch of different roles across strategy, ops, and finance. He gave a quick background, so I won't spend too much more time on that, other than to say I've really seen a bunch of different stages of companies from many different angles. And so what I've done today is distill down what's really, really important in the early stage of building a company from a finance perspective. And finance really touches back into strategy, and that word is really overused a lot. So when I say strategy, and I think for us in the early stage, strategy principally refers to how we are allocating our resources to build product and acquire customers, like very simply speaking. And finance's role that can really help there is to keep score in a quantitative and non-biased kind of way. And so just a couple items of housekeeping real quick. Would love participation, questions, like raise your hand. No one really wants to listen to anyone drone on for 45 minutes about anything without a little bit of back and forth. So really appreciate it. And I might do the old classroom thing where I maybe ask a couple of people, call in the class if I don't get any. And then second, maybe grab a piece of paper or open up a note on your computer. The idea is that I'm going to talk a little bit conceptually and high level, and then we're going to get into some examples and having a place to jot down some thoughts about your company and how you're thinking about things is going to make this much more useful for you. Fantastic. So I'd love to start off with a quick question, poll the audience. Let's assume that all ideas are going to be profitable one day. Your idea is going to build into a profitable company. On a spectrum of 1 to 5, 1 meaning my idea is so good that it's just going to make money on its own. And 5 meaning I know that I need to raise millions and millions of dollars, like I'm building a hardware company or something, in order to get my idea off the ground. Write down where you think your idea falls on that spectrum. I'll give you 5 seconds to do that. So 1 means like the idea is just going to make money. I don't really need to raise any money, or I'm going to make money right away. 5 means I need to raise a lot of money and I won't get any revenue for maybe a year or 2. Okay, so I can tell you that regardless of where you are on that spectrum, all startups take money to run, and all startups require you to understand what your key numbers are. And so that's where we find ourselves on the topic of startup finance today, and leads us to why. Like, why do we actually care? Why should I sit here and pay attention, right? So I would give you 3 reasons that you care about finance. Make it really easy and break it down. And the first is probably the most important. And so if you take nothing else away from this session, take away this, your number 1 job as a leader is to not die. Like, above anything else, no matter what, product, hiring, all that kind of stuff, the most important thing that you can do is make sure that you stay alive. And what that means is you don't run out of money. You continue to keep the lights on, you continue to keep your people paid and yourself paid. And the reason why this is so important is because so much of business in the end is simply about staying alive. Like, if you are alive, there is a chance you will change the world. And if you don't, and you run out of money, you're dead and game over. And Paul Graham of Y Combinator has a great quote and post about this. If you can just avoid dying, you get rich. That sounds like a joke, but it's actually a pretty good description of what happens in a typical startup. And one of the things in Y Combinator that they tell you, Feather was a Y Combinator company. I didn't go through Y Combinator, but got a lot of that information through that. And Stripe certainly is don't die. Like, that's your number 1 thing. So I'm really hammering that point home here. And on a personal level, at Feather, the company that I was previously running, this really, really hit home. And I'll set the stage for you real quick. So the year was 2020. It was early 2020. Feather, we had just closed our Series B, and we had spent almost 2 years to that point developing a brand new product line. So Feather is a furniture subscription company, rethinking people's relationship with furniture. The concept is you don't own the place you live in, you don't really want to own the furniture, you haven't had another option, at least in the United States until now. And so we set out to rethink furniture from the ground up, really complicated global supply chain. And with rental furniture, we also did all of our own delivery in home because the quality of the furniture and reclamation was really critical to the business. And so here we are in 2020, and March 2020 happened. And March happens to be 30 days before we're set to launch this brand new furniture line. All the stuff is coming in from India and China and the United States and all over the world. And COVID happens. And we're in growth mode. We're launching another city. We're launching this product line. And the ability for us, and really me, is what this fell upon, to look at the numbers and very quickly assess what can we afford to do and what can we not afford to do, was the difference between having to like run around like you don't know what's going on, or fire a bunch of people when you don't need to. And luckily for us, the story is happy. Like, we had to shut down the company for 2 weeks and have significantly degraded operations for about 2 months. But in the end, the ability to look at those numbers and say, we can continue paying people for a time, and then we're going to restore people once our operations go, like that was all enabled by the numbers. And so in sum, don't die. Number two, finance you can think of as your ultimate scorecard. And what do I mean by that? In the end, all of our actions as founders, as executives, as leaders, ultimately end up in financial measures. I call financial measures the things like revenue and gross profit and unit economics, those like key top level numbers. I think in the early days, when you are pre-product even and you're in the research phase, it's hard to think about that. But I would say that very, very quickly, and I'm sure some of you have experienced this already, the conversations, if you have with investors or with SEB or an advisor of some kind, very quickly it becomes, well, what is the revenue looking like? What is the profitability looking like? What are those unit economics looking like? And so if finance is our ultimate scorecard and how we are performing as leaders and then as an organization, it really matters. And so second thought experiment for you real quick on that piece of paper. Take 20 seconds, shouldn't take you really more than 20, and write down 3 to 5 of the most important financial measures or numbers that you care about right now. And you should be able to, like, in theory, bang those out in 20 seconds. Okay, so that was about 20 seconds. So if you're not done, that's fine. The point I'm trying to drive home here is you really should have those 3 to 5 things. They may not be things like revenue or gross profit. They may be some sort of customer acquisition metric or an engagement metric even. Like if you're Clubhouse, like you're not making money at the beginning, so you're looking at other key measures. But you definitely want to have those things at the top of your head and know where they are and have an idea of where they're going to go. And that's really the difference between transforming yourself into a rocket ship or a bit of a ticking time bomb in the end. And the third thing, why we care about finance, is they're actually extremely helpful in driving focus. And focus has 2 parts that are important. One is your organization as a whole, but then the second is actually your time. And how you spend your time should be a reflection of your strategy and how you want to allocate your resources. And so that's because time and money are limited no matter who you are. And so the numbers help us take a really cold, hard look, deferential look, let's say, at how things are going. And so I would encourage you to spend your time strategically, not just in thinking, okay, what's the product roadmap and how are we allocating those resources, but how you as an individual spend your time. And I think it's really important for us to productize things in finance, automate them, let's say, where possible. So for example, the more you can leverage out of the box software, like a Shopify or something, means that like figuring out what your revenue is, because Stripe's built into Shopify or Squarespace or whatever it is going to be infinitely easier. And you don't need to either A, spend your time figuring out what that number is, or B, paying somebody else to figure out what that number is. Now, of course, it depends on what you're building. If you're building an app that you're distributing on the App Store, that's pretty straightforward because you're on Apple's App Store and you're going to get some basic data. On the other side of the spectrum, if you're building a custom B2B SaaS application where you're going to be doing billing manually, then that's going to take a little bit more overhead. And that's actually okay because that's the product that you're building. And that's where, it's a really great opportunity to outsource that to somebody. So find yourself a bookkeeper. I think there's two pieces to the very baseline level of finance. There's bookkeeping, meaning recording your actual results on a monthly basis, typically. And then there's like tax. So first on bookkeeping, how much did I spend? How much did I bring in? You can totally find yourself a bookkeeper. I would say ideally someone who is in the tech space, and definitely somebody who is small business focused, like not some larger firm. And you can offload a lot of that to them. I would caveat that what's important though is don't be lazy about this stuff. Offload the repetitive non-value add tasks like assembling the information, but you need to spend your time consuming, understanding, and investigating that information.
Andrew,
go ahead.
Can I jump in with a question?
Sure.
How do I know which numbers I should care about most?
Totally. So it's a little bit outside the scope of what I'm going to talk about here, but I would say for sure, investors from a pure finance angle are always going to care about your revenue projection, your profitability projection. So profitability typically is what are your unit economics? Unit economics being defined as for every 1 unit of what I'm selling, what is the profit that I'm generating from that? So in software, that might be like 90% because your costs are essentially infrastructure, and then you may or may not load headcount costs against that. And then certainly cash burn, which is what we're going to dive into a bit more detail today. Meaning how many more months, the way we phrase it is how many more months of runway do you have left? Meaning if you have X amount of dollars or euros in the bank, you are spending Y per month. That gives you Z number of months until you run out of money, or in reality, raise more money in our world. Outside of that, and again, I'm not going to dive too much into metrics and KPIs here, but there are absolutely a bunch of other metrics and KPIs that are really important. And I think you all have talked about that, or you'll talk about that in a different video. And so that's the other side of this coin. Okay. Any other questions so far? Awesome. So one quick anecdote on this is I was advising a founder at one point, and she had put together her forecast and was out in the market talking to investors, and kind of came to the realization that that it was a little bit early to go to market, right? And we sat down and I said, well, like, what's your forecast saying? What's your runway looking like? First question out of my mouth, right? When are you going to run out of money? Like what's our situation? It's like, well, we've probably got like 3 to 6 months, depending on where we are. And I said, okay, then the next question is, well, what's the product roadmap? Like, what's our strategy? And do we need to, or where can we de-scope? In other words, where can we focus? And so, well, it's like, the first reaction, I've been on both sides of this, right? Is like, everything there is important. It wouldn't be on the product roadmap if it wasn't important. And I said, totally get it, but I'm going to ask you to stack rank those things in priority. What's the most to the least important? And really force yourself to put it in an order. Nothing is equal priority. And so we peeled the layers back, unpacked that, and came up with, hey, we really are trying to do 2 things at once, and we're just too early to do 2 things at once. And so let's pick one thing, make sure that we A, do the thing well, and B, do it on time. And yes, it feels more risky because we're not sort of hedging by doing 2 things. But the reality is we know that investors are responding favorably to both of these things, and actually a little bit more favorably to option A in this case. And so let's just focus on option A, put all our chips on option A, or 90% of our chips on option A, and and we'll do that. And so fast forward, like that turns out to be a happy path, right? We get things shipped on time, we go raise some additional funds, and now we can go and we can consider building option B. Okay, so in summary, 3 things to take away from finance in the early stages. 1, it helps you not die, which is your number 1 job. Number 2, it helps you know what your key numbers are, which makes those investor conversations really easily, or even conversations internally. And then 3, it can really help you focus. Okay, so that is the conceptual piece of this equation. Now I'd like to kind of go into 2 examples. I'm going to keep these fairly simple. And so before I jump into any examples, like any general questions before I jump into that? It's going twice. Okay, great. So here we are. And okay, so I'm going to walk this top to bottom. And this is we're going to do this twice. The first time we're going to do this, so what I call back of napkin math, is basically as simple as it gets. And the second time that we're going to do it is a little bit more scientific, and I'll show you why it's worth spending a little bit of that extra time. But here, if where you find yourself today is I've never really thought about cash burn before. I'm a little bit intimidated by a bunch of these terms that are out there that I keep hearing. Here's a really, really great place to start. My extra simple example. And so let's say that you're out there in the market and you're selling an app for $5 and you think I could get like 2,000 sales a month of that app. And so 5 times 2,000 is $10,000 of revenue. In order to do that, in order to build my app on the expenses side, I'm going to start out, I've got 3 people on my team. And assuming they're all product related people, product engineering, design, I'm going to say that the average product person costs about $10K a month, sort of including some overhead for benefits. And so let's say we've got 3 people at $10K a month, that's $30K per month in headcount. And then let's say on top of that, I don't really know what my other expenses are going to be. I'm going to have maybe a little bit of co-working space, a little bit of travel, a little bit of food. I know that's something, but like, I don't want to get too much into the details. A good rule of thumb here is to take your head count. And this is for a software company, right? Which a lot of us are. Mark up your headcount costs by anywhere between 10 and 30%. And so here I'm showing we're going to mark up our headcount costs by 20%. And so our total expenses per month are roughly 36K. Great. And so what is burn? How much do I spend or make each month is simply revenue, how much money I'm bringing in, less expenses, the money I'm paying out. And so I'm burning 26K. When we talk about what is your runway, the calculation of runway is fairly straightforward. It's simply how much money do you have in the bank today and how much money are you burning every month, and divide those 2 things and it gives you the number of months of runway. So if I say, I'm going to go, we're going to go build this app and we're just going to take it 3 people, we're going to go for 2,000 sales a month. We think we're going to raise 250K. Where does that get us? Like how much time do we have to kind of get there? Simply taking 250K divided by 26K gives us roughly 9 months. And you can see in the formula here, I round down because for safety, basically. And so in my sort of happy path or my best guess, I've got 9 months of runway with those parameters. So immediately I know, okay, I've got 9 months until I need to raise some more money. Is that reasonable? Is that not? Right? It gives you that starting point. Now, the other thing that I always do is I always want to have a range, and I want to have a best guess, and then I want to have a contingency plan. Things really go south, right? And so in this example, I'm saying, okay, well, what could go south? Well, I could not make as many sales as I think I'm going to make, or I could spend a lot more money than I think I'm going to spend. And I think in the early days, we tend to have pretty good control over expenses. Like, I think if you're not going out there just like having lavish dinners or something all the time, your costs are really just for your head count and a little bit extra. And so I think you might say, hey, Andrew, we're just starting out. Making 2,000 sales a month is a lot for right away. That's true. So what's sort of the worst case scenario here is we make no sales. Like, let's say we raise 250K, we have those expenses, but it takes longer for us to actually monetize. We have great engagement metrics. Lots of people are using the platform, but no one's paying us yet. And so here I simply back out the revenue from the cash burn. So cash burn, right? We burned 36K, but we were saying previously we collected 10K of revenue. So the net burn was only 26. Here I'm saying, what if we just burn 36 a month? We get no revenue. And that becomes a 6 months of runway. And so now I have barbell. I have like, okay, if I raise 250K, I know I'm going to have 6 months of runway, worst case scenario. If I can make these sales, I've now got 9 months. So let me pause there. Any questions, comments, concerns?
I think that's like solid foundation. More like most of our companies are between seed and Series A, so one would expect them to have like a good understanding of this, but more founders than you would believe are not thinking this through thoroughly. It's just like shooting from the hip, which could kill a company if you're not following your cash burn.
It happens more than you think, or more than one might think, like, because there are so many other things that we have to do day to day, and building the product is what will get us the money. So, it becomes a little bit circular and hard to prioritize, but some of this really, really quick back of napkin math, if that's all you have time for, can at least act as a warning signal. Because if you come up with like 2 months of runway, or I would say anything 3 months or less, you immediately need to stop what you're doing and get better fidelity on that number. And if it really is like 3 months, then you're probably in a place where you want to start thinking about a top up or a bridge of some kind, or are we actually ready to go to market in like the next 30 to 60 days? Because fundraising is almost always a multi-month endeavor, unless you've got somebody who's really about to write a check. And I would exercise caution on that. Different topic, but great point. And so, yeah, so Seb, to your point, like, this is like, I'm starting out, I haven't really done this, or I'm new to this approach. There are certainly limitations with this approach. And so what I want to now show is going a bit more scientific, like double clicking a little bit on a monthly basis. And so let's take the same example, and I'm going to go pretty quickly here. Same example, $5, and we're going to have 2,000 of sales. Okay, great. We said we had 3 people at 10,000 a month for kind of salaries and whatever other taxes and benefits. But we also know we have got some other expenses. And so we can get a little bit more scientific to get us a better answer. And I'll show you mathematically how this can start to make an actual difference and why you should care. And so we know when we sell things online, we're going to have a processing fee. So that's 3% of sales. We know that like developing software costs money in terms of like AWS time, but also some other software. So maybe for you, that's 2,000 a month because you're doing a lot of R&D and it's very heavy. Maybe that number is like 500 a month, or maybe it's 4,000. Again, this is up to you. And then some travel. So T&E stands for travel and entertainment. Bucket in here, travel, entertainment, food, coffee, that sort of thing. Again, in an early stage startup, it's up to you and your spending habits, but I would say this number should be pretty low. It's pretty easy to think about this on a per head basis from a forecast perspective. So like for every person that I have on staff, I'm spending roughly 200 a month, let's say, on various travel, coffee kind of things. recruiting coffees, like if you do that in a post-COVID world. And then I would say like miscellaneous, which is a kind of grab bag for everything from, oh, I got to pay some lawyers for some stuff, or accountants or bookkeepers, or maybe we're gonna hire a contractor to do some design work or something. Kind of falls in there. And so you come up with 36K. If you do a little bit more detailed buildup, and this is much more similar to how finance professionals will build up forecasts. And so you come up with 26K in monthly net burn. And so as you can see, this gets us to a pretty similar answer to our super simple example. So we're saying in the best case, we've got 9 months of runway. And in our worst case, we've got 7. In this case, our more specific math gave us an extra month in the worst case, but it's still pretty close. Where things get more interesting is when you actually start to put this on a monthly basis in more like a traditional forecast that you should be looking to prep for sharing externally or with your advisors. And so what I've done is I've taken these same numbers and now plotted it on a monthly basis. And so just to show you that the numbers are the same and we're sort of starting from the same place, remember that we said over here, 9 months of runway or 7 months of runway. And in this example here, we've got, sorry, so let me walk you through. In the happy example, our cash balance is going red, is going negative after month 9. So up here, I've got the month numbers, month 9. And so we've still got a positive cash balance in month 9, but then it goes negative. Similarly, down here is where I have the contingency planning of no revenue. And we have 7 months of runway. Okay. So we're starting from the same place. There's a bunch more numbers on the screen and we get to the same example. So why go to this level of detail? Well, let's say the example here is like we're starting a company, right? And let's say it's basically November 2021, and we're going to start this company in earnest in January, just to make it simple. And we're looking at the next year, 2022. Well, first things first, is it really realistic that we're going to end up with $10,000 of sales in our very first month of existence? Maybe. Like, are we going to sell 2,000 units at $5 a unit? Maybe if you've already got a prototype, maybe not. I would say maybe not. Maybe you don't want to forecast that. And so what we might say is,
sorry, Andrew,
okay,
what's our time now, Kat?
We've got about
15 minutes.
Good. Okay. I think we can speed it up as well. I think everyone is following. Perfect.
So let's say you have 500. Let's say you're only going to sell like 100 units in the first month. I might say, okay, we've got $500 of revenue in the first month, and every month we're going to double that till we get to our $10,000, right? And then I might say, okay, well, infrastructure is probably also going to ramp up a little bit. And so maybe it's more like $500 until we ramp up later in the year. And then similarly on miscellaneous expenses, we may have some startup costs. So maybe that's like $5,000 for lawyers, but then really that's like a much smaller amount for the rest of the year. And so you can see, so let's say we have 0 sales for the first 3 months and then we ramp up. You can see that the cash out dates start to change, where instead of 9 months, it might be 8 months or 7 months, even in the best case scenario. And similarly, like our worst case scenario may stay similar or may get worse as well. And so the point I want to make here is like putting this just basically in this sort of template on a monthly basis will really help you get a sense of where your cash burn is. Any questions?
All right, I think it makes sense from my point of view. I think any company that are any startup that are running towards an end where you have to think about your liquidity needs to keep track on this.
100%. Okay, great. So if we don't have any other questions on this, a couple more thoughts before we part here. So you will have or have already had some sessions on fundraising, but a couple thoughts for you from the finance perspective and from my experience having raised a couple rounds of venture capital. First, big picture, you are always in a two-sided sales process. And by that, I mean, it may feel obvious that you're there to sell an investor on investing in your company, but likewise, they're there to sell you. And they're there to sell you because your job is to raise money. Their job is to get the ability to look at every potential investment. Notice I said their principal job is not to invest money. That's sort of secondary. The biggest thing that they want to always do is look at every single deal. And so keep that in mind when it feels, until you basically have a term sheet in hand, things aren't completely real. Okay. Second point, cap table dynamics. So I think we all can get really hung up on dilution and valuation. And I would say in a big picture, a couple % of dilution extra for you in the long run will matter less. Like once your company is a success, you're going to make a bunch of money and everything's going to work out fine. And so, of course, if it's like a crazy amount of dilution, that's one thing. But when you start to get down to something on the edges, don't worry too much about it. It's going to work itself out in the end. And then final point before Q&A here. When fundraising and putting together your deal room, a deal room is just a term used for like a folder in Dropbox or somewhere else that contains things like your pitch deck, your forecast, and any supporting schedules that you may throw in there. 2 to 3 year forecasts, especially if you're pre-Series A, is fine. Most people will ask for 3. And you can get really, really hand wavy in that 3rd year because it's so hard, and that's totally fine and normal. As a corollary, if you get asked if an investor comes to you and asks you for a 5-year forecast and starts asking about things like what is your EBITDA, you're probably talking to a private equity investor who thinks that they want to invest in venture capital. And in my experience, that almost never actually works because they have a very different way of viewing the world. And so with that, happy to dive into anything that I talked about in detail.
Awesome, Andrew. Appreciate it. I have a couple of questions regarding finance strategy in general.
Yep. Yeah, sorry to interrupt. I'm going to launch a poll quickly. There are just 3 questions, so if everybody could answer them, would be great.
Awesome. While that is running, when is a good timing to get the CFO on your team, Andrew? What's your thinking around that?
Yeah, so I think it depends a bit on what is the product that you're building. So if you are building a B2C app, I think a CFO, a true CFO, is probably a later stage hire, like maybe even a Series B or C potentially. I think what's really important at the A that will pay a lot of dividends longer term is that once you've raised an actual A round, you've got some money in the bank, invest in that bookkeeper that I was talking about. And tax is sort of more of a compliance thing, generally speaking. But that bookkeeper will get you your solid foundation of like, what are my actual results? And in particular, depending upon how complex like your revenue is, have them really nail down like what are the right revenue numbers. Really, throughout your Series A, as long as you have those strong financial reports and you yourself can read those numbers and interpret those numbers, like I mentioned, you don't really need a CFO.
Yep. Sometimes I feel like the bookkeeping firms are more like they become almost like AI, like robots, just sending you numbers rather than giving you strategic advice. Like I'm guessing then the whole idea, if I'm having a bookkeeping firm for my day-to-day numbers, the financial strategy is on me as a founder or founding team, right?
Yeah, I would agree with that. I would say that if that's a gap area, because none of us can do everything, it's a great opportunity to hire a CFO either in a part-time context, like as a consultant, or have an advisor on this who has that and brings that to the table. And so, a fractional CFO is sort of the startup term that people are using these days, but whatever format that takes, either as an advisor or as a consultant, they just don't really need to be on staff. And to your point, like a real CFO who's going to bring strategy and really get in and understand your product and what actually matters is rarely going to be the person who's going to keep the books. And so you often need to have two entities of some kind doing those things.
Yep. What's your thinking around valuations for, like, you raised millions of dollars? What's your go-to thinking around getting a healthy valuation that makes sense for you as a company in terms of dilution, but also makes sense for investors?
Yeah, again, it really depends on what you're building. It depends on the momentum in terms of those key metrics and financial measures. Like if you have crazy strong momentum in the last 3 months and a story there. And it depends a lot on market conditions. And I think it's important to recognize that we are in an extremely hot market and have been for a while. And so, a lot of seed rounds have become almost new A rounds. And there's now pre-seed rounds that are more institutional money than they are just angel checks in some cases. And that is in large part a function of market dynamics. And on the flip side, in a post-COVID world, a lot of the global money has sort of woken up to how valuable software companies can be. And so I don't also believe that like, oh, we're in a hot market, everything is double overvalued. But I also am not sure that this is exactly the new normal. Like there's probably a correction there. So it's hard for me to get super specific on valuation without understanding a particular company, but certainly like the general, I guess the best advice I can give with regards to valuation is it really takes you getting out into the marketplace, pitching to a bunch of different people and seeing what the market values you at, right? You could certainly support an A round, for example, at 100 million. You could support an A round at 60 million or at 140 million. Like there's a pretty big range there, and that range has a pretty big impact on your valuation. I think last thought on that, your number one job is to not die. And so what's more important than anything is like, if there's money on the table and maybe you could get another 1 or 2% less dilution by waiting another 6 months or 3 months or an undefined period of time, I would strongly consider taking the money now so that you can get back to work, because fundraising is a massive part of your job, but also building the product in the company is a massive part of your job. And so you need to allocate your time appropriately.
But some investors also getting like really offering bad terms where dilution is like, is this really, it might kill a company or put you in a very tight situation for the next round or future. Like where would you draw the line in terms of what's healthy and more like whatever, and what is like, okay, I cannot accept those terms?
So do you have any? It depends very much on how strong you believe your position is. So if you're in a position where you're thinking, you believe, hey, I have a great story, I have great numbers, I believe in the product and the team, and this investor that's before me is offering me unpalatable terms, add 10 more people to the top of your fundraising funnel, because they're either sandbagging you or they just don't know what's market, right? Like when you're fundraising, I mean, you should have an Excel sheet or an Airtable or whatever, and the top of that funnel should be something on the order of 50 at the low end, because there's a pretty big fall off. And so I would say the first question I would have to that person is like, how many people have you talked to? How many of those are warm intros and how many of those are cold intros? And take it from there. The second scenario is if you're getting a low valuation, but it's because you're in trouble, then it's a tougher situation. I think you probably have two paths there. The first path, and I would recommend taking this route first, is to say, can we refocus? Is there a way that we can cut costs? Even if it's going to be painful, because we think if we have just another 3 to 6 months to hit certain milestones, we can have very, very different conversations with either this investor or with 20 other investors. Like that's the ideal path in the bigger picture. It's short-term pain for long-term gain. You're going to take less dilution. Maybe you're going to find a better investor, by the way, because not all money is equal. If that's not really possible and you're up against the wall, your number one job is to not die. And so take that money, live to fight another day. Know that even if you take a bunch of dilution, there can be top-up equity, not just for employees, but also for founders to solve for that in the medium term.
Yep. Safely, you're in middle of a fundraising, Rava. You're in the middle of a fundraising.
Yes.
Timing right now. Do you have any thoughts or questions to Andrew?
No, I liked the presentation you just did, Andrew. Very useful advice, actually. No, but what are the most important metrics, or what does investors think about when you're raising like a $2 or $3 million round, A round, seed round, whatever you want to call it?
Yeah. What's the product that you're building?
We are a marketplace for security services. So think of it like
physical security.
Yes, security guards. And I don't know a lot about the US, but we are the first in Sweden and have 600 guards in our products. Guards are using it every day, working at in different cities for venues, events, or facilities, or concerts. Thank you.
Yeah. And so I guess if I'm extrapolating like the principal problem that you're solving, is it more from the security guards finding work, or is it from like the companies trying to hire security guards, or is it both?
Both.
Got it. So if you're if you're raising a $2 to $3 million, I would call that probably a seed, more so than an A. Though it depends on the numbers.
I also say that, but my investors say it's an A, but I'm saying nowadays it's a seed round. So yeah.
Yeah. Well, I guess my one question to that is like, are you definitely talking to venture investors? And maybe this is a dynamic in Sweden that is different too, right? Like you do have to acknowledge things are a little different, but like typically seed rounds are in that number. I mean, really, whatever you call the round, it somewhat matters less. I think for you, marketplace businesses are their own animal. And so certainly revenue and unit economics are top questions. But I think after that, it's a conversation around demand and supply. So demand is the company or person buying the service, and supply is your security guards. And so what are the metrics around each side of your marketplace? And one of the first questions I think you'll get is like, what's the constraint? Are you more supply constrained or are you more demand constrained? And whichever direction that is, I'm going to be really interested in what the numbers are. Let's say you're supply constrained, which is pretty common, especially in the early days of a marketplace. What are your acquisition metrics for acquiring supply, and what are your retention and engagement metrics? Like those three things you can apply. And what's your go-to-market, or what's your strategy to drive those numbers? And so you can fill in the metrics from there, but that's probably where I would initially focus. On the demand side, if it's a marketplace where there's on the order of dozen or maybe hundreds of companies out there that buy security services, you probably end up with more of a sales approach than a marketing approach to generate demand, meaning sales is a one-to-one thing, marketing is a one-to-many thing.
Yeah.
And so I would infer that you're probably doing a sales go-to-market on the demand side.
Right now, yeah.
And so, yeah. And so the question there is like, well, what's your sales cycle looking like? What's your CAC from a sales perspective?
Yeah, we are looking to change that by partnering with companies that already have, for example, 500 nightclubs as customers. They get a part of our revenue, so their own sales team sell for us, and we will integrate our product with an event guest list app, so that you can see it. So we're trying that out, and we want to. We are about to close that partnership this week, so it will take a couple of weeks for it to, see some results. But we are looking at that as a customer acquisition strategy. So we'll see how that will work.
Yeah, no, that sounds great. Yeah, and I'm happy to chat more offline, so to speak, if that's helpful.
Yeah, thank you. Glad to hear.
Yeah, I know running up on time. Yeah, anything else?
For me, it's good. I don't know if anyone else want to ask anything. Thank you for introducing me, Sebastian. So,
pleasure, Ola. Sahar, do you have any questions?
No, I don't have any question. Really interesting topic, and it was really good to hear it too. Yeah.
Good stuff. Sorry. So I think if we don't have any other questions, let's.
Could you hear me?
Yeah, I can hear you, Sahar. Oh, nothing. Did you want to ask something, Sahar? I think I'm gonna mute her mic, and then you can unmute if you want to again. Sorry. I think that, like, if I zoom out, look at, we covered general principles. We talked about high level thoughts, big picture versus day-to-day, tactical thoughts, strategy, finance, operations. We talked a little bit about the cap table, dilution evaluation. Andrew, do you want to share a couple of final words for founders and startups regarding the strategy behind startup finance?
Sure. Yeah, I think, look, first principles are stay alive long enough to succeed, and take the time to define those numbers that are important to you and and certainly into investors. It really can help you. It can help you not only succeed, but reduce your anxiety to know where you are as a business, as a founder, to know that you're not going to run out of money, or that you are going to run out of money, but it's 3 months from now. It actually does wonders for your ability to sleep. And so I'll leave you with that thought.
All right.
Thanks so much.
If you can really hear me now, so I would like to thank you. I have a lot of connection issue today, but no, I don't have any questions. It was really interesting topic and really nice to hearing your presentation.
Thank you, Sarah. Appreciate it.
Okay. Thanks. All right, that's it. I'll get the fireside chat started. We're gonna jump in another channel, and we'll be streaming live on LinkedIn and Facebook. If you want to tune in for that, then just jump on our Facebook page and stay tuned for the next session. More details will come soon. Thanks, Kat, for coordinating everything, and thanks again, Andrew, for presenting. Bye, everyone.
Thank you. Bye.